Hello, I'm Andy Prosser. I'm the Head of Investments at InvestEngine. Welcome back to our weekly Market Roundup, which is your quick look at what's been moving the markets and what it means for investors. So this week started well. We had some strong buy the dip action happening on Monday after what was a tough day for markets last Friday. So on Monday, we saw about 85% of the companies in the S&P closing higher for the day, and the US market as a whole rose about 1.5%. Now, quite a lot of Monday's rally was undone on Tuesday, though. There was some data released which showed weakening employment in the US services sector, as well as some sticky pricing pressures. And that combination makes life quite difficult for the Federal Reserve because it's their job to keep inflation low while managing the level of unemployment. Thankfully, though, on Wednesday and Thursday, the market reversed course again. So there was more buy the dip mentality, which took the markets higher. And these gains in the second half of the week were driven by a few things. So firstly, the big US tech companies did particularly well. Apple especially did well after they announced a $100 billion investment in the US that might exempt them from Trump's threatened tariff on chip imports. It was also confirmed that Presidents Putin and Trump will meet for talks within the next few days, which raised hopes of a truce in Russia's war with Ukraine, which the markets liked. And then finally this week, we've seen increasing bets on Federal Reserve interest rate cuts as Trump's new tariffs officially came into force on Thursday. Now, speaking of interest rate cuts, back in the UK, also on Thursday, the Bank of England cut rates, taking the new base rate down from 4.25% to 4%. And that decision was much closer than expected, and the Monetary Policy Committee actually failed to reach a majority decision after the first round of voting, so they had to resort to a second round of voting, which was still incredibly close and ended 5 votes to 4 in favour of cutting rates. And in the accompanying comments by Governor Andrew Bailey, which are usually the interesting bit, he mentioned that there was now, in his words, genuine uncertainty because the committee sees risk to both inflation overshooting its forecasts and growth undershooting. And although the decision to lower the base rate by 0.25% was in line with market expectations, because the decision was much closer than expected, it sent both the pound and gilt yields higher. So the market now expects a roughly 75% chance of another 0.25% cut this year, which is down from over 90%, which is what it was before the decision. So looking back at the last week, then the markets had a strong week overall, despite the sterling strength on the back of the Bank of England decision, and with US optimism fueling most of those gains. If you have any thoughts or comments, please feel free to leave them below. Otherwise, for more updates, please head to our blog, sign up to our newsletter, and we'll be back next Friday. Thank you for watching.